Welcome back. Today we're tackling a topic that impacts everyone: taxes. Understanding a few key tax strategies can save you thousands over your lifetime. This isn't about loopholes for the super rich, it's about practical legal ways for everyday people to keep more of their money. We'll break down tax brackets, retirement accounts, credits, and deductions. No fluff, just actionable tips. By the end, you'll have a clear plan to save money on your taxes next year. Grab a notepad and let's dive in. Let's start with tax brackets, the foundation of your tax strategy. Many people think their entire income is taxed at their highest bracket, but that's not true. The US uses a progressive system. Your income is split into portions, each taxed at different rates. Picture buckets. The first chunk is taxed at 10%, the next at 12%, and so on. Only the money in the highest bucket is taxed at that rate. This is your marginal tax rate. Knowing your marginal rate helps you make smarter decisions about raises, side hustles, and investments. For example, if you're in the 22% bracket, every $100 deduction saves you $22. Your effective tax rate, the average you pay on all your income, is usually much lower than your top bracket. Homework. Look up the current tax brackets and see where you stand. This knowledge is your secret weapon for maximizing deductions and credits. Let's use a real example. If you earn $50,000, only the portion above $47,150 is taxed at 22%. The rest is taxed at lower rates. Don't let tax brackets intimidate you. They're just a ladder, not a wall. Once you know your bracket, you can make strategic moves to minimize your tax bill. The tax code is a rule book full of incentives. Learn the rules and use them to your advantage. The government rewards you for things like saving for retirement or investing in education. Understanding your bracket unlocks these rewards. This is the first step to building a solid financial foundation. Don't pay more than you have to. Know your bracket and plan accordingly. Let's move on to the next big tax-saving tool. Now let's talk about retirement accounts, your best tool for lowering taxable income. Contributing to a 401k or traditional IRA means every dollar you put in is pre-tax, reducing your taxable income. If you make $60,000 and contribute $5,000, you're only taxed on $55,000. In the 22% bracket, that's $1,100 saved instantly. Many employers offer a 401k match-free money you shouldn't leave on the table. If you're not contributing enough to get the full match, you're missing out on a 100% return. Roth accounts work differently. You pay taxes now, but withdrawals in retirement are tax-free, including all the growth. If you expect to be in a higher tax bracket later, a Roth can be a smart move. For many young people, Roth accounts are a great choice. Pay taxes now, while rates are low, and enjoy tax-free growth. Imagine turning $100,000 into $1 million and withdrawing it all tax-free. The key: start contributing, even if it's just 1% of your paycheck, and increase over time. Max out your contributions if you can, but starting is what matters most. Retirement accounts don't just build your future, they cut your tax bill today. Don't wait, take advantage of these accounts now. Check your employer's options and open an IRA if you don't have one. The earlier you start, the more you save, both now and in retirement. Make your money work for you, not the IRS. Next, let's talk about tax credits, where the real magic happens. Ready? Let's go. Tax credits are even better than deductions. They reduce your tax bill dollar for dollar. A $1,000 deduction in the 22% bracket saves you $220. A $1,000 credit saves you the full $1,000. Don't miss out on credits you qualify for. The government is handing you money if you claim it. The Earned Income Tax Credit, EITC, is huge for working families and can be worth thousands. Even if you owe no tax, you can get a refund. Many people miss out on the EITC. Always check if you qualify. Education credits like the American Opportunity Tax Credit up to $2,500 per student, and the Lifetime Learning Credit up to $2,000 can save you big on college or job training costs. Families should know about the Child Tax Credit and the Child and Dependent Care Credit. These can offset the cost of raising kids or paying for childcare. There are also credits for energy-efficient home improvements, adoption, and retirement savings. The Savers Credit. Tax software helps, but don't rely on it alone. Review the IRS list of credits to see what you might be missing. Credits are a treasure hunt. Find what you qualify for and claim every dollar. Even a few minutes of research can mean hundreds or thousands back in your pocket. Don't leave free money on the table. Make credits a core part of your tax strategy. Next, let's make sure you're tracking every deductible expense. The more you know, the more you save. Let's keep going. Up next, tracking expenses for maximum deductions. Stay tuned. Tracking deductible expenses isn't glamorous, but it's crucial for saving money. Most people take the standard deduction, but if you own a home, are self-employed, or have high medical expenses, itemizing could save you more. Itemizable expenses include mortgage interest, state and local taxes up to $10,000, large medical bills, and charitable donations. Don't forget non-cash donations. Clothes, furniture, and more can add up if you keep receipts. If you have a side hustle or are self-employed, you can deduct business expenses, part of your internet, phone, office supplies, and even a home office. The key is to keep detailed records. Don't wait until tax time to scramble for receipts. Use a folder, spreadsheet, or app to track expenses weekly. A few minutes each week can save you hundreds or thousands at tax time. Consistency is more important than the method. Just stick with it. When tax season comes, you'll have everything organized and ready. This habit pays off in real dollars and peace of mind. Don't be lazy. Your future self will thank you. Next, let's unlock even more savings with tax-advantaged accounts. Ready to level up? Let's go. On to tax-advantaged accounts. Beyond retirement accounts, there are other tax-advantaged accounts that can save you big. The Health Savings Account, HSA, is a triple tax-advantaged powerhouse. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. To qualify, you need a high-deductible health plan. Check if your employer offers one. Pro tip: if you can, pay medical bills out of pocket and let your HSA grow for decades, then reimburse yourself tax-free in retirement. After age 65, you can use HSA funds for anything. Just pay regular income tax if not for medical expenses. Flexible spending accounts, FSAs, let you set aside pre-tax money for healthcare or dependent care. But you usually have to use the funds within the year. The Dependent Care FSA lets you save up to $5,000 pre-tax for childcare, huge for working parents. These accounts are direct incentives to help you manage costs and lower your taxable income. Ask your HR department what's available. You could uncover thousands in savings. Don't overlook these tools. They're easy wins for your wallet. Use them to pay for things you already need and keep more of your money. Tax-advantaged accounts are a secret weapon. Make them part of your strategy. Next, let's make sure you're not leaving money on the table with your filing status. Filing status can make a bigger difference than you think. Let's break it down. On to filing status. Here's what you need to know. Your filing status directly affects your tax bill. Don't overlook it. There are 5 main statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow R. Most married couples save more by filing jointly, but in some cases, like high medical expenses or student loan repayment, filing separately can help. Head of household is a hidden gem for single parents or those supporting a dependent. It offers a higher standard deduction and wider tax brackets. To qualify, you must pay more than half the household expenses and have a qualifying dependent. Life changes, marriage, divorce, a new child, can change your best filing status. Don't just repeat last year's choice, review your options every year. The right status can mean thousands in savings. Tax software can compare options, but double-check yourself. Take a few minutes to confirm you're using the best status for your situation. It's a simple step with a big payoff. Next, let's talk about estimated taxes for freelancers and side hustlers. If you're self-employed, this is for you. If you're self-employed or have a side hustle, you need to know about estimated taxes. Unlike employees, you're responsible for paying taxes throughout the year, usually in 4 quarterly payments. Miss these payments, and you could face penalties. You pay both income tax and self-employment tax, Social Security and Medicare, about 15.3% on top of regular income tax. A good rule: set aside 25-35% of every payment you receive for taxes. Use IRS. Form 1040 ES to estimate what you owe each quarter. If your income fluctuates, you can pay based on actual earnings each quarter. Tracking expenses is crucial. Every deduction lowers your tax bill. If this feels overwhelming, consider hiring a CPA for your first year. They'll help you set up a system and avoid costly mistakes. Don't ignore your tax obligation. Set up a separate account, know the deadlines, and pay on time. Discipline now saves you from a nasty surprise later. Being proactive is the mark of a true business owner. Estimated taxes aren't optional. Plan ahead and stay stress-free. let's wrap up with your action plan. You've got this. Here's how to put it all together. You've learned the essentials: tax brackets, retirement accounts, credits, deductions, and more. The goal isn't to cheat the system, but to use the rules to your advantage and keep more of your money. Everyone's situation is unique, so consult a tax professional for personalized advice. Start tracking your expenses, contribute to tax-advantaged accounts, and review your filing status every year. Take small, smart steps now for big savings later. If you found this helpful, hit like and subscribe for more money tips. Drop your best tax tip or question in the comments. We're building a community to help everyone save. Thanks for watching, and see you in the next video.